Hello, good morning everyone. It's a true pleasure to host you again at Next Block Expo, this time in Warsaw 2023. We were so much empowered by the last edition in Berlin. We learned some lessons, we received tons of positive feedback from you, so we decided, and I can commit from that stage, that there's going to be the next Block Expo in the upcoming year being organized in Berlin. But today and tomorrow, we prepared for you a lineup of really prominent speakers and brands that you can learn from. And also networking, I was already mentioned, like last year, you were reaching out saying, like, Tom, the networking in Berlin was fire. Like the people meetings, this app, I was excellent. So we decided to do it again today. If you haven't done it already, please download the Brella app. You can just flip your badge. At the backside, you do have a QR code. You can scan it, you can download it. Then you personalize your profile. You express your goals and interests. You get to the matchmaking. This matchmaking is a shortcut for you to set up effectively meetings. There is a networking place, the networking zone on the floor 3. In the upstairs, there are 20 tables. They were occupied all the time last year. Hopefully it's going to be the same this year. So reach out to each other, make some connections. Speaking of connections, by heart I know that crypto unites people. Not longer than a month ago, I guess, I was in Switzerland at the wedding of a friend that I made like 3 years back then, and that's a crypto friend. So I wish you to initiate some new long-lasting relationships during the Expo event. Today, some of you know me and my investment activities under a brand called Blockchain Ventures Hub. For today, I prepared a keynote about how to improve investment strategies using some sort of knowledge usually accessible only to the VCs. It's called Unfair Advantage. Invest in crypto like a VC. There are different strategies of investing, and most likely you've been asking yourself this question: how can I invest smarter? How can I be a better investor? And there are, different people showing sort of strategies, and most of them are just using the emotions to leverage that and to manipulate. I'm saying most of them. What I'm going to share with you today is my experience in the last 3 years investing at the early stages, more than 50 startups, and these lessons are meant to improve your strategies, your tools that you use to analyze projects. Bear in mind, it's not a standalone strategy. It's something that can add to your investors' kind of methods and the way how you do your research. Can let's say, build your thesis or break it? The big question is, do you think these seed and pre-seed investments are easy? I can tell you from the experience they are not. Like most of these projects, they're not going to survive. That's one thing. And a big chunk of these projects, they're not even getting to the TGE event. So usually it's more like ungrown trees planted on the desert, especially after the bear market. The key to execute the strategy that I'm going to tell you is to get the pitch deck. What is the pitch deck? Pitch deck is a set of slides used by the founders to convince investors to actually invest in the company. So these are all these promises that they made, like back then when they were fundraising, kind of a vision that they want to execute on, sort of state of the business as it was back then, and some methods how they plan to drive from point where they were to point where they believe they will be. And it's important that you get that document. How to do it? As easy as sometimes just typing that in Google. You can get to the Discord and directly ask founders, or maybe like analyze the cap table, like who invested in that project. Maybe you know some people working in these VCs. Maybe you know some people from the groups that were investing in that project. Anyway, you need to get that pitch deck to make the strategy effective. But without further ado, let's jump to the lesson number 1. So investment form. It really matters what kind of exposure VCs are having on the project. For years, it's been SAFTs, so sales agreements for future tokens, where early investors, they were having actually token exposure only. Then, let's say during the market or shortly before, the market kind of transitioned to more equity investments. It's called safe investments. It's not because they are safer. SAFE stands for Sales Agreement for Future Equity. And then there is a hybrid form called SAFE plus token warrant. Means like there is like a double exposure, both on equity and tokens. And think about it for a while. If investors are invested in SAFE, in the equity, and you are invested in the token, and you look at the tokenomics, and it feels like most of the value accrual goes to the equity because they wanted to satisfy the investors, I'm telling you, you are on the wrong side of the bet. Or if there is a SAFE agreement and token warrant, and you feel like this tokenomics is really weak, investors are like in a candy store. They just got some bonus. They just got some tokens, and guess what they're going to do? At the very first occasion, they're going to dump on you. On the contrary, when you do have a very strong project in terms of tokenomics, and there is equity and token deal, that's the best deal you can have. Lesson number 2, it's called Roadmap Reality Check. So within that pitch deck, what they usually commit is a very specific roadmap, kind of an action plan, how they want to get effectively from where they are to the moment of kind of fulfilling their vision. When you are analyzing that project, usually when it's available on the spot market, you can actually think of what kind of size of the gap there is between what they promised and where they actually are. If it's like a big gap, you should start worrying about that project. And you better bet on what I called shippers. Means these kind of teams that ship no matter what. They're heavily focused on delivering on the promises from the roadmap. Why it's important to bet on these guys? Because when the bad times come, trust me, all of the investors are turning into some freaking apes. And guess what they're going to do? Yeah, they're going to dump on you. That's correct. On the contrary, I'll give you an example. After the Terra crash last year, that meant to be like a start of the bear market, there was at least one team that I know that was heavily focused on building among that chaos, among that like bad emotions. The Kujira team, they within like a 7 or 8 weeks, they built like a new blockchain on Cosmos. And that gave a boost of confidence for the chart to go up at the very moment when the market was drowning, essentially. So it's important to bet on shippers during bad times because it's what protects your capital. Other than that, your capital will be melting like an iceberg exposed to a significant amount of sun. Lesson number 3 is the leverage. Always look for a leverage, something that feels like a competitive edge within the project team, something that gives you that additional boost of confidence. Be it a very strong team in the vertical that the project is actually building, or maybe that might be like a community from their previous project, maybe some very strong partnership with someone important on the market, something that gives you that feeling. You need to identify it. These guys are having a leverage. Lesson number 4, they promised some kind of the roadmap and KPIs. Look at their money spending habits. Are they actually investing that money to drive from point A to point B to get to the milestones that they promised, or they maybe just are throwing money away and yachting and traveling and showing off and kind of spending investors' monies on toys? look at their Twitters, and see what's actually going on and where the money flows. Lesson number 5, cap table. So it's always good to understand who invested before you. In the current state of the market, there are mainly 2 types of investors. One, more like an institutional investor, so the VCs professionally managed with liquidity providers, with fund managers, general partners, all these strategies that are meant to protect the capital. And on the contrary, there are groups of people, sometimes called like pooled groups. They're actually usually, again, a bunch of friends, not that professionally managed, and they're basically investing in projects in hoping to have some general exposure to Web3 space. What happened on the market after the last bear is that investors are more cautious. They start to pay more attention on traction, on business models, on any kind of proof that this team can actually deliver. Is there any substance, like a business substance in that project, or is it just a sheet of paper and a nice vision? Overall, it's good to have more of an institutional investors in the cap table. But do not look only on the quality of these investors, but think of the quantity. Like if you know how big was the raise, let's say it was like $2 million. And if you see like 50 investors there, what's the average ticket size? Is that small? So then the question is like, who is actually having like a real skin in the game? Who is gonna be with the project when the bad times come? They just tip their toe with a small ticket size. So the very occasion that happens on the market, and they have their tokens unlocked, they're gonna dump on you. That's for sure. If you know the cap table, you can also analyze their investment thesis. So what they think about the market, about what are the verticals that they want to invest in. You can read it on their websites, right? And then if their investment thesis and the project that you analyze, kind of a view of the market and principles are convergent, then it's a higher chance that the investors are going to sustain, be more for a longer time perspective within that investment. But the first question you need to ask yourself is if these VCs are having any thesis at all, or they're just having like a pray and spray strategy, trying to get some generic exposure to the market and run away after the first possible occasion and dump on you. The next lesson is traction. This is a beloved word now. Not sure like who of you is building a startup. Is there anyone? Are you raising now? I guess at least some of you. So you know what I'm talking about. Investors now really love traction. So they want to understand what are your KPIs. How do you set KPIs for yourself? Like how do you measure them? What are your milestones? Are they measurable or just kind of a vision? So traction is something that distinguishes Peter Pans of this world, all of these founders that are building all the time. This kind of vibe of entrepreneurs in the house, like we are building, startupping all the time. Or there are another section of these founders that are heavily focused on delivering on the plan. They're sticking to the plan. They're highly disciplined, and they are taking their KPIs and traction seriously. The next question is the concept itself unique? Do they bring any kind of innovation to the market? Or are they just a copycat? And don't get me wrong, there's nothing wrong when using open source code, for example. We're living in an open source era. But still, even if they do it, you need to understand what's their competitive edge. What's the leverage that I mentioned before? Usually investors, they prefer to invest in these projects that are building something significant, and they're highly disciplined. They're progressing on the roadmap. They're hitting the milestones. They're sticking to the KPIs. Why is that? Because this is some kind of a guarantee from themselves that in the longer time perspective, within the worse market conditions, they, as fund managers, can confidently stick to the projects, and their liquidity providers are going to support them. So if the project that you are analyzing is not having that kind of a vibe, go away, because the very moment that happens on the market, and when it's available for the weak projects, they're going to dump on you. So the summary itself is, at first, get the pitch deck. Pitch deck is crucial because that's your source of information that is giving you some kind of the unfair advantage over the market. Secondly, it's not a standalone strategy. It's some kind of a principles and lessons that you can use to build your investment conviction of the project that you already found. 3, reality check. So you check the roadmap, what they promised, where they are. Did they execute the promises or not? What's the gap between the promises and the actual state of the business? Number 4, cap table tells you a lot. Know your kind of investors that invested before. So know your opponents in a sense, right? You need to understand like who and on what terms, under what investment thesis made a commitment. There might be your best friends and supporters of your investment, but you need to understand like who actually did it. 5, what kind of form of exposure to the projects they have. Do they have tokens, equity, both? You're having tokens, they're having equity. Just think about it. And in the end, always bet on shippers. Bet on strong teams. Bet on teams that are capable of delivering on their promises. I know that during the bull market, it's very tempting to just jump here and there and invest in multiples 3 times, 4 times, 10 times, and just search the gems and everything, and that's fine. But still, if you want to protect the capital in the bit longer time perspective, bet on shippers. All right, we got to the end. If you want to reach out to me, under the Tom Kopera handle, you can reach out on Telegram or on Twitter. You can read more about investment activities of Blockchain Ventures Hub at bbhub.com. And we also are preparing a project of professionally managed syndicate of crypto angel investors. If you would like to have an exposure to early stage projects, you will see these stickers all the way around. I guess on the TV screens, you will have also these QR codes. You can scan them and fill in this little form where you can kind of apply to be whitelisted on a list of potential investors to that syndicate. Strongly encouraged to do it if you feel like investing at the early stages. Thank you so much, and have a good and wonderful, actually, 2 days of the conference. Make a lot of connections, have a lot of fun, and I wish all of you tons of learning experiences. Thank you so much.